Traders and investors all over the world try to time corrections, crashes, bear markets, and panics because, after all, if you time one of these perfectly, the idea is that you can sell when it's at its highs, buy when it's at its lows, repeat, and just essentially trade really well and make constant profits. But of course, this is not easy to do. This is very, very difficult. And in fact, I'm going to walk you through 10 really important facts about this process in markets, including what it means, how to think about it, and to get the data in your hands so that you can potentially invest or trade better, trying to time these historic market moments. So, one of the first things I want to read off here is the frequency of corrections. Also, before I do get to this fact number one, I do want to jump over to fact number two and just remind you of something. A correction is defined as a 10% decline or more. A bear market is defined as a 20% decline or more. Okay, now that you have those terms, let me read off fact one, which is about the frequency of corrections. So how often do these type of drops occur? Does it happen a lot? Does it happen a little bit? What's the story here? Well, since the beginning of 1980, there have been 13 corrections in the S&P 500, indicating that on average, stock market corrections happen once every 2 years. So stock market corrections happen once every 2 years. And actually, since 1980, there have been 13 of these 10% corrections. Now, that might surprise you because that's actually not that much. A 10% drawdown is not that much, especially when the market's at all-time highs or 52-week highs. But nevertheless, it does happen, just maybe not as much as maybe the headlines might lead you to believe. 13 of these since 1980. Now, moving on to fact number two, I think it's very important to read this part because it's going to once again tie into fact number one, and I'm going to show you how to measure these corrections or bear markets. And that is that a bear market correction is defined as a 10% decline in one of the major US stock indices, typically the S&P 500 or Dow Jones Industrial Average, from a recent 52-week high close. A bear market decline is a decline of 20% or more from a recent high. So a correction is 10% from a recent high. A bear market is 20% from a recent high. Now, what's interesting to add to this so you really can see the range of these drops, because a 10% is a correction, 20% is a bear market. Well, there have been some pretty large crashes and panics way beyond 10%, 20%. In fact, the largest correction ever was a 57% drop from its high in October 2007 all the way to the bottoms in March 2009, which essentially was the global financial crisis. So let's talk about both of these facts now on a chart with actual, analysis going on. So you can see how this looks directly on a chart in front of you. Now I'm going to delete these drawings here to make this as crystal clear as I can, because the first thing I want to show you is the art of drawing a correction. So I want to actually go back in time here to get rid of all this price action. And now you can see on this chart here, there was this high right here. This looks like it was on Thursday, the 27th, July 2023. Then price got as low as this line here, which appears to be Friday, the 27th, October 2023. Now, what type of drop was this? Was this a correction or a bear market? Or maybe something less or more? Well, if you measure the percentage change from the very high to the very low, you are going to see exactly what that number is. Now, in this example, it looks like it's about 11%. So from the very high to the very low, price in the S&P 500 dropped about 11%. So that is a correction, because recall that a correction is about 10%. A bear market would be 20%. So that is a correction. Now, how do you time this? How do you plan ahead for this? Because at every corner, it just kept essentially dropping down, and it dropped from July all the way to October. Well, we're really going to get into that as we move on in this video. But the key next step here, now that you know how to draw them and look for them and mark them down, is to now also speak about the historic crash of the great financial crisis. Because after all, the financial crisis is one of the most historic crashes ever recorded. The most amount of people ever were participating in markets. The most amount of money was on the line. And this is the biggest drop that essentially markets have ever seen in terms of sheer value. So this is October 15, 2007. You can see this line we have here. And this bottom looks like February 2009. So quite the bear market to last for that long. And if we take our percentage change and we look at it from the bottom, you can see right here, 57%. So price got absolutely crushed. Now that is worse than a correction. That is worse than a bear market. That's a flat out crash. That's a panic. Now, there's no exact terminology for crashes and panics, but this is what crashes and panics look like. A 50% drop is just one of the worst, and it's sort of going to come down to you as the investor or trader to try to figure out when these are happening. One thing I will say as an anecdote for these types of market events is to pay close attention to the ongoing nature of it. What I mean is, this crash did not happen overnight. It was a long, drawn out time that lasted from the high here. Essentially, when the markets hit this all time high in 2007, price went down all the way into 2009. That is going to exhaust a ton of people. It's going to wear people out. It's going to be harder to follow markets, to be interested, to keep your money in, all of those things. So when you're really looking for a crash or a panic, this is something to pay attention to. How long has the market been going down for? And by the way, what's very interesting is that crashes and panics often come from a bear market. So recall, a bear market is a 20% drop. So you can see here, the market was down about 20% up until these levels right here. So from its recent high all the way down to here, it was down 20%. Now, that's a bear market, but that's not a crash. You can actually see the crash really begins once the bear market breaks, because then it went from going down 20% into a bear market to dropping 45% more from that level. That is just simply, it's not unheard of because it happens, but that's where you're often going to see crashes come from. When there is this level of weakness, it hits bear market territory. There's just no buyer stepping in here. They can barely defend the level. Then it breaks lower. And actually, if you really want to get a look for how that looks, look at the size of these red candles here, which demonstrate just how much selling was going on. So you can see this candle here, that's a massive red day. This candle here, massive red day. And really what you can gain from this is that understanding the terminology, corrections, and bear markets is the first step to understanding when a crash might occur or what they may look like, or essentially what these bear markets can eventually turn into. So that's really the key. But keep in mind how long this period is, 2 full years. And of course, don't forget the original stat that I kicked this video off with, which is that these types of corrections, even just 10%, only happen once every 2 years. So now that I've walked you through fact number 1, fact number 2, and fact number 3, you're really getting an understanding of what is happening. But there's a whole lot more to discuss. In fact, I've got fact 4, fact 5, and fact 6 right here that I'm going to read off. Okay, let's talk about the average decline when these corrections happen. The average decline during a correction is about 13.7%. Now, if you go back to World War II, not 1980, now World War II, it appears that there are 26 market corrections to analyze. So the average decline during a correction is about 13.7%, and that is averaging out since World War II. So 13.7% means not every correction is perfect at 10%. Keep that in mind, because if you are looking to try to time these types of trades, you think that you can perfectly time these market bottoms or these market events. Just because something drops 10% does not mean that it is going to essentially, return to that previous high. In fact, oftentimes it might go a whole lot lower. So keep that in mind, that this may happen. It's not just a 10%. In fact, 13.7% more so seems to be the average. So keep that in mind. 10% is just sort of an arbitrary number, but when you actually look at the average over all of these corrections, it's more like 13.7%. Okay, let's look at fact number 5, recovery time. Historical analysis shows that corrections result in a 13% decline, as just mentioned, well, 13.7% to be exact, and take about 4 months to recover to prior levels on average. This recovery extends if the market falls into bear market territory. Now, before I dive into that analysis, let me also read fact number 6 about the length of corrections. The average correction takes about 6 months to find a bottom. The length varies, with some corrections lasting weeks or months, while others can last a year. So, this is very important. So, first of all, they're getting 2 key facts here. Fact number 1 is that it takes about, on average, 4 months for price to retrace. That's what this fact number 5 is saying. It's talking about the retrace. Now, I'm going to show you what the retrace looks like so you know if you ever time a bottom in markets or try to get that next dip buy, well, you're going to have some data to work with. So, the retrace is essentially when it finds its low, and then how long does it take to get back to its previous high? So if we look at this correction, which I'm marking up right here, let me make this a little more easy to see. So we can see the highs were here, and then since that point, price dropped, right? Just kept going, and it finally made its low, and then it kept going up from there. Well, if you time that bottom perfectly, so let's say you literally bought this bottom, just know that you're in for a process. Because if you recall, from this data point, fact 5, it takes about 4 months to get back to the prior levels. So if you bought this low exactly, sit tight. If you think you got it, sit tight. Because on average, it takes 4 months for price to get back to that previous level. Now, in this example here, is actually rather quick. It dropped 10% and it got back to its previous level right here in 42 days. But when you look at all the data going back in time, you'll see it actually normally takes about 4 months. So know that and have some patience if you ever do perfectly time the bottom. Which leads me though to fact 6, which is super important because this is also about the aspect of waiting for the correction to find its bottoms. So this is different than fact number 5 in the sense that when these corrections occur, when the drop starts, it takes about 6 months to find a bottom on average. 6 months. So when the drop first begins, you have to be ready to be patient, knowing that the correction, as mentioned in the 2007 financial crisis example, is not just going to happen overnight just like that. There's going to be a process involved. It could take up to 6 months. In fact, if we even just look at this from the drop all the way to here, looks like it was 84 days. So it was quite a drop just in this example, but we can go through many more than that. In fact, let's look at this here. So from this high all the way down to these lows, wow, that was a 26% drop from 2022, from early 2022 to late 2022. And let's just see how long this took to essentially find its bottom. It took 280 days. So these things take time. When they start, they take time. And this is also going to be a very important point here when I get to point number 7. I'm going to go to my next slide here and get to point number 7, which is that this is why it's so hard to predict corrections, because most people who attempt to predict corrections do not go in with the mindset that this is going to take a lot of time and that they need to be very patient, because they think they can just get fast money, time the bottom perfectly, and become the next Warren Buffett. It rarely works like that. There are all of these statistical pieces of data that you want to digest and learn from so that your expectations are correct. So now let me read fact number 7 about corrections, bear markets, panics, and crashes. The longest period without a correction, or that means by extension a bear market or crash or panic, was from 1990 to 1997, so 7 years. That's 7 years without a 10% drop. We may never see a moment like that again in our lifetimes because of the changes in technology, the speed of trading, the amount of people involved. Things have really changed in markets. So the longest period without a correction is 7 years, but that's another example why calling these types of crashes and trying to time bottoms is so difficult. The reason is because these bull markets can go on forever. 7 years. In fact, we're going to go back to that time. It looks like it was 1990 to 1997. So let's just zoom in here and see what's going on. And I mean, that is a remarkable move. So from about 1990 to from this, so 1990, this low right here. So the market did correct. It looks like in early 90s. And then from that point in time, it essentially just climbed higher for 7 years until its first 10% correction. And let's even see if we can map this correction out before our eyes here. It looks like it was right there, 1997, just as the data said. But look how smooth this uptrend is. That is quite smooth. And in fact, yes, there was this brief correction here, so 7 years, but look what followed, which is another example of how, for example, these types of processes take time. And when you read that there wasn't a correction for 7 years, the first thing you may think is, well, I'm sure that first correction was enormous. But to the contrary, because strength begets strength in markets, there is momentum, there are trends, the news picks up, people get involved. And you can actually see that after this correction, markets actually just ripped higher. It just continued on, and that went into the dot-com bubble of 1999, 2000, and 2001. So this is really some important data to know about markets. Let's talk about fact number 8, the quickest 10% decline ever. So recall that I've spoken quite a bit about being patient. Well, there has been some fairly fast 10% declines, and those are essentially moments whereby there's a flash crash or there is a very panicky moment where markets sell off very quickly. And you can go look for flash crashes all throughout time because they occur. Usually they're about 5%, but they have been 10%. You can think about Black Friday or Black Monday. These were crashes in the 1980s. So if you want to see a flash crash, let's actually go back here. Sorry about that. If you want to see a flash crash, I'll take you back to 1987, and you can see this flash crash, 1987. Let's see, there it is. You can see this really easily on the chart. So this is a weekly chart. This was a devastating crash, and if we share this to a day, you'll really see what happened on particular days. But those two candles are 2 weeks worth of trading. So now you can really get a feel for just how intense this was, 36%. And if you just count these two candles here, from that point to that point, it's 30%, 2 weeks, 30% gone in 2 weeks. That's a really fast crash. This hasn't happened for a long time, but it's good to know it can happen. I mean, that is just, it's historic, the amount of selling that happened there. So with that being said, I think it's time that we move on now to fact number 9. And hopefully nearing the end of this video and you're walking away with a ton of new information about markets, because that's why I'm making these videos. Okay, let's talk about the duration of bear markets. Since World War II, there have been 12 bear markets with an average decline of 32%. These bear markets typically last longer than corrections, with recovery times varying widely depending on the cause of the downturn. So that's fact number 9, and there's some important things I want to say about fact number 9. First of all, this is about bear markets, so this is 20% or more. Most of this video has covered corrections and bear markets together, but really I've been focusing on corrections, the 10% moves. But bear markets are 20% or more. That's a painful drop. There have been 12 since World War II. Now remember, World War II ended, it's 2024 at the time of this recording, so some 70 years ago. So in those 70 years, there have been 12 moments where there have been huge bear markets, and when you add up those 12 bear markets, divide by 12 to get the average, you'll see that the average decline is 32%. And this ties back to the point I was making about the 2007 financial crisis, which is that these bear markets can last a long time, up to 2 years. In fact, most bear markets, when they begin, really don't resolve themselves until 12 months later at least. They can take a year, which ties into the point of this video, which I think you're seeing as an underlying theme, which is the patience that's needed, the understanding of how rare these events are that's needed, and just knowing that they can take time and that they're really freaking hard to time But if you are going to try to time them, you have these facts to work with. And I think number one, if you think you've got either the bottom of a bear market or a correction, or you think you're timing the top, so things are starting to sell or crash, well, you got to know it's going to take time to develop. But nevertheless, if you do catch a bear market, the average is 32.5%. So recall also as well earlier, corrections are 10% or more, bear markets are 20% or more. Just because something has dropped 20% and is now in a bear market does not mean that's the end of it. In fact, the average after that is 32.5%. So there might be more selling to come. So that's fact number 9. And now let me end up on fact 10, which I don't think people are going to love, but I think it's very important to say. Fact 10 is that no one has predicted crashes consistently. No one. Now, there are some traders who have predicted crashes and made an absolute enormous amount of money. But I can tell you that was most likely the last crash that they've ever predicted. They've tried again and lost, tried again and lost, tried again and lost. George Soros broke the Bank of England, got really rich and wealthy. Not really sure he's timed another crash as perfectly as that ever since. Michael Burry, we know him from The Big Short. He timed the 2007 crash really well, perfectly. Not really sure he's ever timed another crash as good as that. Not sure if he ever will. Because if you see from this video just how rare they are over the period of time in markets and the amount of time it takes for them to develop, it's just really not on your side to predict such. Now, there is a caveat, though, to that because these stats will help you get prepared for them if they come, or if you think you've timed one perfectly. But also that I think there's a lesson here from Burry, from Soros, from all the other people who have timed these bear markets, even Buffett, who has historically bought when there's been tons of panic, huge crashes, which is this. If you ever do time one, know that that is an excellent, excellent gift to have. It is something that is rare and does not happen often, whether it's luck, skill, or being prepared. It doesn't matter. You did it. And if you do it once, take your loot, take your treasure chest. There's no reason to try again because doing it again just is going to be quite difficult. And as we were showing, bull markets can go on a long time. From 1990 to 1997, there wasn't a single big market crash. So that's 7 years. So if you time one perfectly, whether you're short or you bought the bottom perfectly, well, don't then take all those winnings and just risk it all trying to do it again because you might just end up giving it all back. So the point here is to walk you through these 10 facts and to get you prepared for bear markets, for corrections, crashes, and panics. And I hope that this video helped. I have many more on the way, and I've also posted an article about this on my website. So thanks for watching.